Picture this. You wake up one morning, grab your coffee, and find out that the primary export tax for your business just spiked by a staggering 82% overnight. No warning, just boom. Well, that's exactly what happened in the Indian petroleum sector back in mid-July of 2026. Okay, let's dive into this.
Welcome to today's Explainer. We're unpacking the Windfall Ripple, decoding India's July 2026 fuel export levies. We're going to look at how a massive, sudden tax hike like this ripples through an entire economy. We'll trace it all the way from giant oil corporations right down to the price you might end up paying at the pump.
Here's our roadmap for today. We'll cover the surprise tax hike, decode exactly what a windfall tax is, look at the impact on oil refiners, explore the Reliance SEZ loophole, see what this means for consumers and airlines, and finally, wrap up with the investor takeaway.
All right, kicking things off with Section 1, the surprise tax hike.
Take a look at these numbers from the Ministry of Finance, which kicked in on July 16, 2026. Notice the crazy contrast here? The export levy on regular petrol was actually reduced slightly, dropping by 1 rupee and 50 paise to 2 rupees 50 paise per liter. But look at high-speed diesel and aviation turbine fuel, or ATF. Both of those saw massive 7 rupee per liter hikes. Diesel jumped from 8.50 to 15.50, which is that dramatic 82% increase we mentioned earlier, and ATF nearly doubled, going from 7.50 to 14.50.
So, why the sudden whiplash? Well, it wasn't just pulled out of thin air. The government's move was driven by a really sharp increase in international oil prices, which rapidly crossed the $100 per barrel mark. This price surge was completely fueled by heightened geopolitical tensions in West Asia and an escalation of hostilities between the United States and Iran. When global crises push oil prices up like that, the math for domestic refiners changes practically overnight.
Moving right along to Section 2, decoding the windfall tax.
Now, what exactly is a windfall tax? Basically, it's a higher tax rate levied by the government on specific industries experiencing unexpected, outsized profits. The absolutely crucial phrase to remember here is due to favorable external conditions. See, these windfall gains don't come from a company's brilliant innovation or better management or some fancy new investment. They happen simply because global crises, like those West Asia tensions, drive up crude oil and fuel prices globally. So the government steps in to ensure these extraordinary, essentially unearned profits are shared with the public exchequer.
So how does this actually play out in the real world? The Indian government watches this like a hawk through fortnightly reviews. Every 2 weeks, they check the average international prices, specifically tracking global Brent crude. And keep in mind, this isn't a permanent tax, it's totally dynamic. If global prices suddenly crash, this tax can be dropped all the way to zero. It specifically targets the Special Additional Excise Duty on exports. And why do they go through all this trouble? Mostly to fund government subsidies, and, crucially, to discourage companies from exporting too much. They want to make sure there's always plenty of petroleum available right at home for the domestic market.
Let's look at Section 3, impact on oil refiners.
To really put this into perspective, for every 10 crore liters of diesel exported, a 7 rupee hike translates to a 70 crore rupee tax hit. That is a massive bite out of a company's margins. But here's the thing. The pain is not felt equally. This brilliantly highlights the divide in the refining sector. On one side, you have standalone refiners like MRPL and Chennai Petroleum. They take a huge direct hit on their earnings because their business model relies heavily on capturing those strong global export margins. But on the other side, we have the integrated oil marketing companies, the OMCs like Indian Oil, BPCL, and HPCL. Their position is way more balanced. Because they operate massive domestic fuel marketing networks, they sell tons of fuel within India. By using their elevated domestic marketing margins, which were recently estimated at around 27.7 rupees per liter, they can actually offset a lot of the losses they take on the export side.
Which brings us to Section 4, the Reliance SEZ loophole. And this is where it gets really interesting.
When you talk about Indian fuel exports, you absolutely have to talk about Reliance Industries, right? They operate one of the world's largest refining complexes in Jamnagar. But there is a massive loophole at play here. Reliance actually operates 2 distinct major refineries in Jamnagar. One is a 33 million-ton facility that mostly serves the domestic market. But the second one, an absolute behemoth with a 35.2 million-ton annual capacity, operates entirely within a Special Economic Zone, or SEZ. And here is the kicker. A government official actually clarified that SEZ exports are entirely exempt from these specific export duties due to previous judicial rulings. So, while all the other refiners are taking that painful 7 rupee hit, Reliance's massive export-focused SEZ refinery is just cruising along, remarkably protected from this specific levy.
All right, on to Section 5, Consumers and Airlines.
Now this brings us to the burning question you're probably asking yourself right now. Is my next road trip going to cost me a lot more at the pump?
The short answer? Thankfully, no. You can totally breathe a sigh of relief and put the bicycles away for now.
Here's why. The government made it crystal clear that domestic excise duties remain completely unchanged. Think about it. High export taxes actually make selling domestically way more attractive for these refiners. That means more fuel stays inside India, which boosts domestic supply and significantly lowers any risk of a fuel shortage. The exact same logic applies to domestic airlines like Indigo and Air India. They don't pay this export tax on the aviation fuel they buy for flights within India. Now, this doesn't mean we're completely invincible. Both everyday consumers and airlines are still exposed to the underlying global crude prices. If international crude just keeps soaring, pump prices and airfares might eventually have to rise, but it definitely won't be because of this specific export tax hike.
Let's wrap things up with Section 6, the investor takeaway.
Check out this timeline because it perfectly captures what we in the financial world call policy risk. Look at how fast things change. On July 1st, 2026, the government actually reduced these export duties. Fast forward just 15 days later to July 15th, the Ministry of Finance issues new notifications, and literally the very next day, on July 16th, duties are abruptly hiked back up by 7 rupees per liter. It just goes to show how wildly the landscape can shift based on crude prices and refining margins.
So, what's the bottom line here? For investors, predicting refinery earnings just got a whole lot more complicated. Moving forward, here's what you really need to track. First, watch those global diesel and ATF crack spreads, which is essentially the profit margin for turning crude into fuel. Second, monitor corporate SEZ exemptions, exactly like the one shielding Reliance. Third, keep a close eye on overall refinery utilization to see how efficiently these companies are actually running. And above all, anticipate frequent government tax revisions. Because remember, strong global margins are great for corporate profits, but the government is always watching, and they are always ready to take their cut of the windfall.
Which leaves us with this really profound question to chew on. Are extraordinary profits a national resource or a corporate reward? When a global crisis pushes oil prices sky high, who should ultimately see the financial benefit? Is it the companies refining the fuel, or the citizens of the country it's exported from? It's a fascinating policy dynamic right at the heart of this entire topic. I really hope this explainer helped you understand the mechanics and the massive ripple effects of India's windfall tax. Keep questioning, keep learning, and I'll catch you in the next explainer.